right, welcome back to another video. Here we got the Dividend dudes, Brian and Tom, and the dude behind the camera. We're back with another month stock pick. And this one, the whole theme was we doubled down. Meaning we didn't buy any new stocks. And we're going to get into a bit of why that happened here in a moment. But first, we need to address what did we buy?
We bought General Dynamics, REO, and then 3M. And those three companies, one of them is a defense contractor. REO is a mining company, and we'll get into the reasons why we bought those in a minute. And then 3M, if you guys have watched the videos, you know why we bought 3M. Twice now. This is our third time. We keep buying 3M.
So why? Why did we buy those instead of going out?
Well, like I said, we're lazy.
I don't think we're lazy. I think what happened was we looked at the stocks that we might want in the future, and they came up lacking.
We're not even ambitiously lazy?
No.
Yeah, so if I'm going to be concise explaining why we bought this, we talk about diversification. We've talked about diversification, I don't know what, like 24 times
Like every
now.
video?
Every single video. So this month, if you look at our spreadsheet, we went through even completely different numbers than normal. The reason why we did this is because we need to balance out the diversification in our portfolio. So if you look at all the stocks in the list, we have all of these stocks already. So we just added to the shares of companies that we already own. And why do you do that? Well, you want to make sure you're diversified in different business sectors. So in this case, these three were underweight compared to some of the stocks that we had in our portfolio that had a lot more. I mean, you don't want to have good examples. We bought Intel back when we were doing $400 a month in our original investment, and they went up like 60%. Well, then we have other stocks that we have $3,000 worth of money in, and you don't want to be that lopsided, because if one sector goes down, your portfolio gets really badly affected if you're overweight that way. So we're just trying to balance things out and make sure that the companies in this list stay profitable across the broad range of spectrums of businesses and industries.
Yeah, so we're going to answer the question, why did we didn't do new stock here in a moment, but we decided to double down this time, and you can see the amounts we added to each of those. Each of these have shown that they were worth buying again, obviously at this point. You want to add any details to that, why they were worth buying right now again?
It's a difficult time to be buying stocks right now. The stock market trailing price to earnings ratio, if you're a nerdy technical guy and you want to get into all these numbers and metrics, it's very overpriced. So there's not a lot of stocks right now that are an easy, oh, that's a great value play. That's a good company that can grow and pay us a healthy dividend if something happens. So we tried to look at companies in our list, and if you look at our portfolio, most of them are doing pretty good. So we tried to find ones that are depressed relative to their earnings. Like, you don't want to be buying Intel after they went up 70% in 1 year.
Right.
So in this list, we tried to look at it. 3M in our portfolio is not doing relatively great. It's not doing terrible. I mean, we're getting paid a dividend. REO is doing, I mean, they're doing okay, but they're not like Intel. And then General Dynamics is a defense contractor. Most of it's just trying to balance that out. Why did we buy those three? Well, there's a war in Ukraine, and we're using all of our weapons arsenal supply to supply that war, and we need to replenish that. And the Biden administration just spent $61 billion to fund these companies to produce more weaponry. Not that that's a good thing because of what they're doing,
right,
but for a business standpoint and from an investment standpoint, that looks good.
But not just Ukraine, Israel, Syria, all, there's a lot going on right now.
And it's really sad, like what's happening. It's not good. So that's the first one. That was one that we had originally bought with $400, so we're just trying to double that up and make it more equal weight with the rest. We know it's not where REO and 3M are, but we'll get it there, just not right away. The second one on the list is REO. This is a mining company, and we have a video that we'll talk about this a little bit more, about why we buy suppliers to major, like the Magnificent Seven, versus buying the actual Magnificent Seven. REO supplies lithium, copper, all sorts of metal material to a ton of different industries, including the automotive industry. Anybody own Tesla stock? So we bought them just to add it to it because their financials look great, and if you look at the spreadsheet, you'll see that they came out pretty good on those numbers. That's what that's for. That's to help us reinforce our decision, not necessarily make the decision for us. It's just to help us. It's like a gut check. It's like, hey, is this a good buy, or are we being stupid? So we bought REO Mining Company just to level out the portfolio, and because of the prospects that they just added like a whole new facility. Like they discovered a huge mining facility and they got authorized, I think, in Canada to do something that's going to make them a ton of money. So we bought them. And then 3M, why are we buying more of 3M? Well, 3M got through their lawsuits. They got through that. Their profit margins look a little bit better. They still have the mask issue with the military that is getting settled. I think it was completely settled, but they got to pay that now. So the financial metrics of this company look like they are on the upswing. So if you want a healthy dividend check, that's the one that you buy.
Love it. Love it. I feel like that kind of answered this first question we had over there on the why, right? Mm-hmm. Why do we double down on these? Because they show positive indicators across the board, and for the reasons you just shared, right? I think that brings us to the next question here. Why didn't we look elsewhere outside of what is already in the portfolio? Why didn't we look at new stocks?
We did look at new stocks.
So I'm surprised you asked that because you know better.
we looked at all the industries that we don't have right now that we could diversify into, and it's just not time. There's beaten down stocks, but they're companies that aren't healthy. And there's healthy companies, but they're way above what we want to buy them for. So we need to have the companies that we want to buy come down a little bit so that it's a great time to buy.
Yeah, and there's sectors that we don't have really any presence in. The REIT, the real estate sector, we don't have a lot of weight in this particular portfolio for that. We're going to get there, but like Brian said, it's not there yet. So we didn't add new stocks. There's another reason why is we have to pay attention to the businesses we buy. If you've got 100 businesses you got to pay attention to, that sucks.
You cannot look into the finances of 100 companies every month, and that's a full-time job.
Yeah, so we try to keep the number under 30, and I've got, in my personal portfolio, I've got 3 of them. One of them has got 36 stocks in it. So when you start loading down on it, you just get your news feed in your portfolio, it starts getting, it's like Microsoft updates. They just keep coming. It's like, oh, I can't keep up. So we try to keep that number low enough to be able to understand what's happening with these companies because, quite frankly, we're giving them money. You're giving them your money. You need to know what they're going to do with it, right? So it's easier to do that with less companies than it is with more companies.
Absolutely makes sense. So, well, reading between the lines here, we did look at other stocks, but the other stocks, for the reasons we shared, the other stocks we didn't find anything for this month that were worth adding to the portfolio. And I think we were discussing before recording this, next time we're probably going to be looking at diversifying even a bit more for the reasons you were just sharing, Tom, right?
Just trying to level out the portfolio. It's a risk mitigation tool. That's really what it is.
Yeah, 100%. So the reason we didn't do new ones this month is for those things. We didn't want to get too complex, and we did look. Didn't find anything that fit the criteria.
I found some doozies. I mean, you got the Magnificent Seven that just defies all logic. I mean, they're still going. Don't know why, but they're still going. And then you've got like the real estate market. We've been talking about that for over a year now. And finally, I'm seeing it show up in all the reports. It's on fire. The operating revenue is like in the red. I mean, most all of the REITs, especially the commercial ones, are looking awful. So even though we want to buy them, we need to see 2 consecutive quarters on reports in an REIT where their cash flow and their net operating revenue shows a positive, at least turning the corner positively. Not necessarily a great number, but I mean, God, you look at an LE Capital, MPW, CIO, AGNC, IEP, any one of those, there's a ton of them out there that, I mean, it's a bloodbath. I mean, right now. So when that bloodbath ends, we'll buy into the sector. But why would you do that now when they could still have farther to fall? You want to make sure that your money is well spent and not just going into somebody else who will spend it and you'll never get it back.
Right.
So it's a kind of on fire that's not good.
Not a good fire. Yeah. No, this is a bad fire. This is one where you might not have a house afterwards.
Yeah. It's not a bargain bin stock.
Yeah. We like depressed stocks, but depressed stocks that have good earnings.
Right.
Stocks that have profitable margins, net operating revenue, their earnings per share is relatively high, their PE ratio is relatively low, their cash flow shows a positive trend, their assets go up, their liabilities go down, their dad jokes are extremely good. I mean,
All right, I think that brings us to the next thing. We were talking about why not the Magnificent Seven. And the crazy thing here is, before recording, we were realizing, you know, we could make an entire dedicated video to this because it's a question on a lot of people's mind, right? Why aren't we doing that? And so at this point, unless you have anything to say about the Magnificent Seven,
One thing.
do you have anything to say?
I have one thing to say.
All right.
Buying the Magnificent Seven is like trying to get Darth Vader in Blue's Clues.
What?
It doesn't exist. Darth Vader does not exist in Blue's Clues. I think that's what he's trying to say.
Well, he could. He could be in Blue's Clues.
I've never seen
He
him.
might decapitate the dog, but he could be in Blue's Clues.
But there's always a Magnificent Seven. There's always a Fang Stocks or, you know, whatever out there. And whatever dictate.
Force choke the guy who's mail time. Okay.
Shut up.
All right. So now we'll talk about that. No, that's the only thing I got to say is there's a lot to that. And if you want to see that, we have a video for that. It's coming.
All right, so there you have it. Go ahead and subscribe so you don't miss that video, and we'll see you next video.
What's wrong with Darth Vader and Blue's Clues?